something strange happened in global finance this year. The Japanese yen fell to levels not seen in decades. Japan stepped in to defend it, then Washington joined the intervention. The United States started buying yen too. Think about that for a second. Japan is not a fragile economy asking for a rescue. It has its own central bank, its own currency, and trillions in financial assets. So why did a problem with the Japanese yen suddenly become an American problem? Because countries are no longer connected only by trade. They are connected by debt. And no debt on earth matters more than America's. Welcome to COVID cartel. Every empire has a story it tried to bury. This is where that story gets dragged back into the light. The United States now owes almost $40 trillion. You do not need a treasury bond in your portfolio to be exposed to this. If you have a mortgage, a car loan, or a retirement account, the price of your money is already tied to a number most people have never bothered to understand. This is not a story about a spreadsheet in Washington. It is a story about the invisible plumbing that decides how expensive your life gets. And it starts with a question almost nobody in finance likes to answer out loud. If everyone on Earth is lending America money, what happens the day they start asking for more in return? Start with the basic mechanics, because almost nobody outside finance actually learns them. The US government spends more than it collects in taxes, year after year. To cover the gap, the Treasury borrows. It sells securities that say, in effect, lend the government money today, collect interest, get the principal back later. Short-term paper is called a T-bill. Longer maturities are Treasury notes and bonds. Banks own them. Pension funds own them. Foreign central banks own them. American households own them through retirement accounts they rarely look at closely. That matters because Treasury securities are not just Washington's IOUs anymore. They are collateral. They are reserve assets. They are the benchmark used to price almost everything else in the financial system. A mortgage rate, a corporate loan, a car payment, all of it sits downstream of what investors demand to hold U.S. government debt. The debt is not an abstraction sitting in Washington. It is the plumbing underneath your own borrowing costs, whether you ever notice the pipe. Look at who actually holds it. Roughly 2/3 of the publicly traded portion sits with American banks. Pension funds, mutual funds, insurers, and the Federal Reserve itself. The remaining third, close to $9 trillion, is held. Japan is the largest single foreign holder, at roughly $1 trillion, according to U.S. Treasury data. China holds around $800 billion. When people say the U.S. owes China, they are technically correct and almost entirely missing the point. That slice is about 2% of the total. Most of America's debt is owed to America. That circularity is not an accident. The Treasury issues bonds. Banks and funds buy them. The Federal Reserve often buys some as well, creating new dollars in the process. Taxpayers fund the interest payments, which then flow back into American pension accounts and insurance reserves. Follow the money far enough, and it mostly returns to where it started, just wearing a different label. This system took decades to build, and it started with a collapse most people forget. After World War II, the dollar was tied to gold, and much of the world's currency was tied to the dollar. In 1971, President Nixon ended that convertibility. Economists expected America's monetary privilege to weaken. It didn't. The dollar stayed dominant anyway. Trade kept running in dollars. Commodities kept pricing in dollars. Central banks kept stockpiling dollars as reserves. That created a strange loop. Foreign countries sold goods to American consumers. They earned dollars. Those dollars needed somewhere safe and liquid to sit, and the obvious destination was U.S. government debt. A former French finance minister Valéry Giscard d'Estaing gave this arrangement name back in the 1960s. He called it America's exorbitant privilege. The United States could borrow in its own currency from a world that actively wanted to hold dollar assets. Argentina cannot do that. Turkey cannot do that. Countries that borrow in someone else's currency learn a painful lesson the moment investors lose confidence. Their own currency falls, their foreign debts get harder to repay in local terms, and capital leaves the building fast. America never had to learn that lesson the same way. It supplied the currency everyone else needed to hold. For half a century, almost nobody else on Earth could borrow the way America could. This is not a small technical advantage. It is closer to a subsidy the rest of the world pays, without ever voting on it. Every dollar sitting in a foreign vault, every barrel of oil priced in dollars, every emerging market bond issued in dollars. All of it quietly reinforces the same demand for American debt. The privilege was never really about American virtue. It was about a system with no serious alternative deep or liquid enough to replace it. Japan became one of the most important pieces of this machine, and its path there starts with one of the biggest bubbles in modern financial history. In the late 1980s, Japanese property and stock prices reached levels that made no economic sense. Then the bubble burst. The Nikkei collapsed. Land values fell for years. The Bank of Japan eventually pushed interest rates towards zero, and later below zero, trying to force the economy back to life. Those extraordinarily cheap rates created a global strategy that traders still use today. Borrow yen almost for free. Convert it into another currency. Buy an asset that pays a real yield somewhere else. That is the yen carry trade. You do not need to run a hedge fund to understand the mechanics. Borrow $1 million worth of yen at close to zero interest. Convert it into dollars. Buy an American security paying 4 or 5%. The spread looks like free money. The catch shows up later, when you have to convert those dollars back into yen to repay the loan. If the yen suddenly strengthens, the trade turns against you fast. This is not a niche strategy confined to a handful of traders in Tokyo. Cheap Japanese money has been woven into global capital markets for decades, funding positions in American stocks, emerging market debt, and commodities far beyond Japan's own borders. Japan's own institutions built up enormous reserves alongside this, much of it parked in dollar assets, which is exactly what turns a domestic currency problem into a global one the moment the yen moves to fast in either direction. Trillions of dollars in leveraged positions now depend on a currency pair most viewers have never traded. That is the uncomfortable part. Nobody voted for the yen carry trade to become load-bearing infrastructure for global markets. It became that anyway, one cheap loan at a time, over 3 decades of near-zero interest rates. Japan also built up enormous foreign reserves over those decades, much of it parked in dollar assets. That becomes important the moment the yen falls too far. A weak yen helps Japanese exporters. It also makes imported energy and food brutally expensive, because Japan imports almost all of both. Eventually, the pain gets politically loud enough that Japan intervenes. To strengthen the yen, Japanese authorities need to buy yen, and to buy yen they need to sell something else, usually dollars. One available source of dollars is their enormous holding of U.S. treasuries. Here is where the myth needs to die. If Japan sells $100 billion of treasuries, Washington does not receive a bill for $100 billion tomorrow morning. Someone else simply buys those bonds instead. The debt still exists. What changes is the price. Picture a bond worth $100 that pays for dollars a year. That is a 4% yield. Now, imagine a major holder starts selling a large quantity of similar bonds. Buyers grow cautious. Maybe they will only pay $90 for that same bond now. It still pays the same for dollars. For dollars, on a $90 purchase is a higher return. The price fell. The yield rose. That inverse relationship bond prices down means yields up is one of the most important rules in finance, and almost nobody outside a trading desk ever learns it. Now, put that mechanic next to the $40 trillion number. The United States never stops issuing new debt to replace maturing debt. If investors can suddenly earn 5% buying existing bonds, they will not accept 3% on new ones. Market yields drift higher, and higher market yields translate directly into higher borrowing costs for the government on every single new bond it sells from that point forward. Nobody has to sell a single treasury for this to matter. The market only has to demand a slightly higher price for showing up. Rising yields matter enormously to Washington because the United States never actually finishes borrowing. Debt matures constantly. New deficits need financing every single year. This is where maturity becomes the hidden variable. Picture two homeowners who each owe $500,000. One locked in a 30-year mortgage at 2%. The other has a loan that resets every 3 months. Rates suddenly jump to 6%. The first homeowner has a problem eventually. The second has a problem almost immediately. Government borrowing works the same way. Long-term, financing absorbs rate changes slowly. T-bills mature in a year or less and get rolled over constantly at whatever rate the market demands. The more debt sitting in short maturities, the faster rate changes reach the government's actual bill. Net federal interest spending has climbed toward becoming one of the largest line items in the entire federal budget, according to Congressional Budget Office projections. That number does not move slowly. It moves at the speed of the shortest bond on the balance sheet. T-bill supply alone has run in the range of $6.5 trillion in recent years. That is not a rounding error. That is a mountain of debt that has to be refinanced every few months, at whatever rate the market happens to be charging that week. The Federal Reserve does not directly set that rate. It sets the federal funds rate, the anchor at the very short end of the system. And short-term Treasury yields live in the gravitational pull of that anchor. If safe overnight money pays close to 4%, nobody is going to lend Washington money for 3 months at 1%. Compare that to a household budget for a second. A family that refinances its mortgage every 90 days feels every single rate hike almost instantly. A family locked into a fixed rate for 30 years barely notices the same hike for years. Washington behaves like both households at once, because part of its debt is locked in long and part of it resets constantly. The short end is the part that keeps finance ministers awake at night. Economists have a name for the extreme version of this problem: fiscal dominance. It does not mean the United States is there today. It describes a regime where government financing pressure becomes so large that monetary policy stops being able to focus purely on inflation. America has lived through a version of this before. Starting in 1942, the Federal Reserve agreed to keep short-term Treasury rates extremely low to help finance World War II. It worked for a while. After the war, that arrangement became uncomfortable fast because inflation surged and the Fed wanted room to fight it. The Treasury wanted cheap financing. The Fed wanted independence. That conflict produced the Treasurer-Fed Accord of 1951, which ended the Fed's obligation to prop up the government's borrowing costs and became a foundation of modern central bank independence. That history matters because it exposes the trade-off hiding underneath today's debt debate. A heavily indebted government prefers lower rates because lower rates make its own debt cheaper. A central bank fighting inflation sometimes needs the opposite. Those two goals do not automatically agree. When they collide, something has to give. Inflation has not disappeared as a constraint either. Consumer prices have continued running above the Federal Reserve's 2% target through 2026, which means Washington cannot simply order interest rates back towards zero to solve its own financing. problem without risking a fresh round of inflation elsewhere in the economy. The room to maneuver is narrower than the debt figure alone suggests. This is the part most debt debates skip entirely. People argue about the size of the number, 40 trillion, 50 trillion, whatever it eventually becomes. The number by itself does not decide anything. What decides the outcome is whether the government that owes it and the central bank that is supposed to control inflation want the exact same thing at the exact same time. History says they usually don't. This brings the story back to Japan because the recent intervention revealed a mechanism most people have never heard of. The Federal Reserve operates something called the Foreign and International Monetary Authority's repo facility. Shortened to FEMA, it lets approved foreign central banks temporarily exchange U.S. Treasury holdings for dollars, instead of dumping those treasuries into the open market. In plain terms, a country under pressure can borrow dollars against its treasury holdings rather than selling them outright. The facility was not built for this specific moment. It emerged from the market chaos of 2020 and later became permanent U.S. Treasury. Officials have publicly discussed expanding it. The financial system now contains a mechanism designed, in part, to help America's own largest creditors get cash without becoming forced sellers of American debt. That is not generosity. It is self-interest wearing a disguise. Protecting a creditor's liquidity protects the market for your own debt at the exact same time. Think about what that quietly admits. The system now contains machinery built, in part, to help America's own largest creditors avoid becoming forced sellers of American debt. Nobody announced that as the goal. It emerged because the alternative, a major creditor dumping treasuries in a panic, would hurt everyone standing near the fire, Washington included. Every generation builds a mechanism like this without ever naming it out loud. In 1951, it was an accord between two institutions. In 2020, it was an emergency repo facility built during a market panic. Now, it is a permanent piece of plumbing sitting quietly behind the scenes, waiting for the next currency that wobbles. The tools change. The underlying problem, a government that cannot afford to let its creditors panic, does not. The old fear that China or Japan could simply dump America's debt and destroy the country misses the actual mechanism. Selling $1 trillion of treasuries would hurt the seller too, and there is nowhere else on earth deep enough to park that much capital. Nobody is holding Washington hostage in a simple game of financial chicken. The real vulnerability is quieter than that. Creditors do not need to stop financing America. They only need to demand a little more to keep doing it. The gap between a world willing to lend at 3% and a world that demands 5% becomes enormous once debt is measured in tens of trillions. America's greatest financial power was convincing the world to hold its debt. Now that debt is approaching $40 trillion, and keeping that confidence intact has quietly become part of the machinery itself. The world cannot destabilize American treasuries without hurting itself. America cannot assume the world will keep financing it cheaply forever either. Japan's yen crisis looked, on the surface, like a Japanese story. It wasn't. It was a small window into the machinery underneath the entire global financial system. Japan needed a stable currency. Washington needed stable markets. Foreign authorities needed access to dollars without becoming forced sellers. Everyone involved had a reason to keep one localized problem from turning into a much larger one. And that shared incentive is exactly what makes the whole arrangement fragile and durable at the same time. That is the part nobody puts on a headline. This is not a story building toward a single dramatic collapse, a bell ringing, a market crashing in an afternoon. It is a story about a system engineered, quietly and deliberately, to never let any one problem become sudden. Every wobble gets absorbed, refinanced, and repackaged before most people ever hear about it. The $40 trillion number does not end in a crash. It ends or doesn't end in a slow negotiation over who pays a little more to keep the whole machine running one more year. History doesn't repeat itself. But if you don't understand it, it tends to destroy you the same way. If this uncovered something you always suspected, subscribe. Every empire has a story they tried to bury, and I'll keep digging